All right, let's get right into it. Today, we're scrubbing in for a deep technical checkup on a stock that's on everyone's radar, Netflix. Now, it's been looking a little under the weather lately, but is there maybe more to the story? Let's dive in and find out. And really, that's the big question, isn't it? On the surface, the chart looks pretty sick, not gonna lie. But are there faint heartbeats, some hidden signs of life that maybe the rest of the market is missing? We're about to put on the stethoscope and find out for ourselves.
So to be clear, there's no guesswork here. Think of this whole thing as a complete diagnostic workup. We're running the labs, we're checking the vitals, and we are analyzing the scans, all using cold, hard technical indicators to get a data-driven picture of this stock's true condition.
So here's our diagnostic plan for today. We're going to start with the initial diagnosis, then we'll check the vitals, look for any hidden signs of life, measure exhaustion with a full-on stress test, outline 2 possible futures, and finally we'll write a prescription with the one number you absolutely need to watch.
First things first, we have to look at the patient's chart. And the most glaring entry, the one that just jumps right off the page, is the primary diagnosis, a confirmed, undeniable downtrend. And this right here, this pretty much illustrates the problem perfectly. With the current price hovering around $103, Netflix is trading more than $10 below its 200-day moving average, which is basically its long-term health baseline. In the world of technical analysis, this is the textbook definition of a bear market. The patient is officially running cold. And the other symptoms just confirm that diagnosis. It's stuck in the bottom half of its yearly price range, and all the short-term trend lines are stacked above the price, pressing down on it like a heavy blanket. All the signs are pointing to one conclusion. Sellers are in complete control, and this stock is, without a doubt, unwell. But hey, a simple diagnosis never tells the whole story, right? So now we check the vitals, because this is where we find a really surprising reading, one that kind of complicates the entire picture.
Okay, now what's really fascinating about this slide is this number right here, 9.32. That's the risk-to-reward ratio. Now, you have to understand, in trading, anything over a 3 is considered pretty noteworthy. Reading above 9? Wow, that's an extreme that just demands our attention.
So what does this vital sign tell us? It means that even though the stock looks weak, the potential reward for a bounce from these levels is over 9 times greater than the risk of it continuing to slide. It's a signal that the selling might be stretched to its absolute limit, creating a kind of coiled spring situation for contrarian traders. That surprising vital sign leads us to order some more advanced scans. We need to look beneath the surface for signals that might contradict that initial, kind of grim diagnosis. So let's see what these deeper tests reveal. And to really understand this next scan, you need to know about this powerful thing called bullish divergence. It sounds a little technical, but it's actually super simple. The stock's price is falling, but an underlying strength indicator is quietly rising. It's a classic clue that a downtrend is running out of gas. And here it is, clear as day on the Netflix scans. While the price has been falling, that's the obvious weakness. The ADOSC indicator, which is kind of like a money flow tracker, has actually been creeping up. This is a huge tell. It suggests that while a lot of sellers are panicking, somebody with some deep pockets is quietly accumulating shares. And the source analysis calls this what it might just be, a classic bear trap. The weakness you see on the surface is shaking out all the nervous sellers, which allows more sophisticated investors to build a position before a potential reversal. It's a real sign of life, but it's happening in the shadows. So what do we have? We've got a sick patient, but with a surprisingly strong heartbeat hidden on the scans. So the final test is a stress test. Just how tired are the sellers? Are they on the verge of total, complete exhaustion? The initial momentum readings are pretty telling. The RSI, it's getting close to that oversold line. The MACD still shows the bears are in control for now. But one of these gauges isn't just low, it's basically flatlined in a way that's just impossible to ignore. Just look at that. 0. A perfect 0.0000. This is the StochRSI reading, an extremely sensitive measure of recent momentum. And a reading of 0 is the absolute floor. It literally cannot go any lower. So the crucial takeaway here is that this reading means that the stock is completely, utterly maxed out on downside pressure. The sellers have thrown everything they have at it, and they have nothing left. The patient has hit rock bottom, and from a purely statistical point of view, a technical bounce isn't just possible, it's now highly probable.
Okay, the tests are in. The diagnosis is bearish, but the vitals are contradictory, and the stress test shows complete exhaustion. So, it's time for the prognosis. Based on all of this data, we have two very distinct paths forward.
On one hand, we've got the bounce scenario, which is fueled by all those exhaustion signals. If the bulls can push the price through that resistance at $104.09, the runway is pretty much clear for a relief rally up toward $106. But on the other hand, if the underlying sickness, that downtrend, takes over and breaks key support at $102.06, well, the fall could accelerate down towards $101.
So with two competing futures on the table, we need a prescription. What's the single best way to monitor this patient's health from here on out? Well, it all boils down to one critical number.
This is it, $102.93. This is the technical pivot point. You can think of it as the center line, the precise battleground where the fight between those exhausted bears and the hopeful bulls is going to be decided.
And that brings us to our final takeaway from this checkup. The long-term trend is clearly bearish, no question about it. But the combination of that hidden buying pressure, an extreme risks-reward setup, and absolute seller exhaustion makes a short-term bounce feel almost inevitable.
And that is the billion-dollar question, isn't it? The charts are screaming that a relief rally is overdue. But is it just a dead cat bounce in a fundamentally sick market? Or is this the first real sign of a genuine recovery? The patient is definitely showing signs of stabilizing, but only time will tell if it has the strength to truly get back on its feet.